At what point can I access the money from my whole life insurance policy without getting a loan? My name is Carmen.
And I'm Darius.
And we are the founders of Wealth Nation. Now, to answer this question, the answer is you can access the money from your whole life insurance policy at any time, but your policy has to be enforced, meaning official, and you have to have cash value available. So as long as those two things are intact, you can request money at any time. But to go a little bit deeper into this subject, Darius and I are financial coaches, and we teach a concept called infinite banking. Now, the premise behind infinite banking is we utilize a whole life insurance policy designed for maximum cash value growth as our savings vehicle. And the reason being is because within a whole life insurance policy, you're guaranteed to earn a 4% compounded interest rate, which is huge. So we put as much money in a whole life insurance policy as we possibly can. And the way in which we access the funds is in two different ways. We primarily teach people to get a loan. And the reason behind a loan is because, one, it's a non-taxable event. When you request the funds, they get direct deposited into your account, and because the act is a loan, it's a non-taxable event. The other reason being is because when you request a loan, the money that you're actually accessing isn't yours. It's not the money from your policy. The insurance company collateralizes your account and gives you their money instead. And that's huge because since you're using their money, that allows your money to earn the guaranteed 4% compounded interest uninterrupted, which allows you to borrow more and more money every year because of that uninterrupted growth.
And when it comes to a withdrawal, it's basically the complete opposite. A withdrawal, you can be taxed on that because it's counted as income. Now, the money that you use to deposit into your whole life insurance policy is after tax dollars. Now, what happens inside that policy is the compounding interest inside that policy allows it to grow and have more cash value every single year. Now, when you withdraw that money is counted as income and it is taxable. So in essence, what you do is you pay taxes on it twice when you think about it.
Yeah.
Now, the second thing Carmen mentioned is compound interest. In order for compound interest to work, the money has to sit there. And what you're able to do when you borrow money from your whole life insurance policy is your money inside your personal whole life insurance policy is sitting there earning that guaranteed 4% compound interest year after year for the rest of your life. Now, when you withdraw that money, you disrupt that growth. And when you disrupt that growth, you don't get the same amount of growth as you would see if you were to borrow the money.
And again, kind of going back to the loan, the loan versus the withdrawal piece of it is when we access the loan, that money that we access, now it's in our account. So we can utilize it however we feel free to, and we utilize that money to create cash flow. So now that it's in our savings account or our checkings account at our local bank, we can withdraw from that money at any time without it being an issue. But the main thing that we always suggest is requesting the loan so that you can earn that uninterrupted compound interest.
Yes. When you borrow from your insurance policy, you borrow from it with a purpose. And that purpose is to finance something that you would have financed through a different institution. Now, when you finance things from different financial institutions, you pay principal and interest on the loan that you are receiving. And the only thing we're teaching with this infinite banking concept is to treat yourself exactly the same. The principal and interest that you're spending out to someone else, you can be spending back to yourself and make yourself a bill.
Yeah.
Now, that cash doesn't have to go back to the insurance company. We do pay a fee of 5% simple interest. So if there's $1,000, you're going to pay $50 back to the insurance company, and you keep the principal to continue to work.
And how the insurance company gets their money back from that loan that you took is they deduct whatever the outstanding balance is from your death benefit when you pass, which makes it really flexible because in today's days, when it comes to your finances, things can change.
Right.
So this gives you the flexibility and the breathing room that you need to be able to pay back the loan when it makes sense for you.
Right. question is, at what point can you take money without it being a loan? Again, you can do that at any time. But the concept that we teach is to borrow money so that you don't disrupt the compounding interest and you don't pay taxes on that money because it's going to be counted as income. Now, make sure you like our video and subscribe to our YouTube channel.
And also check us out on Facebook and Instagram at wealthnation.io.
Remember to own your own lifestyle,
or someone else will.